we expect to continue to see, improved or robust consumer spending. We believe some economies that are still going to have elections might see some fiscal spending. Also, we believe that the disinflation trend will even continue, and this would all mean that global growth might even improve in the second half of the year. For inflation, we expect the disinflation trends to actually continue, and drivers of this outlook would be the fact that we believe commodities prices will remain stable. We also expect global energy prices to remain stable. We believe that the labor markets across these economies are actually beginning to stabilize. Also, we believe that if we continue to see improvements, if we continue to see the monetary policy that have maintained high interest rate environment, which has curtailed a lot of unnecessary spending in some of these economies, those are the things that might drive lower inflation figures for some of these economies. And then what we expect the monetary policy to do as a result, we believe that the Eurozone already led the pioneered the rate cuts scene. We saw them cut rates by around 25 basis points in June. And we believe that if the disinflation trend should continue, we'd actually expect to see the US and even the UK maybe follow suit with at least one rate cut before the end of the year. Also, we believe that the improved supply conditions, as things are beginning to return to normal, coming from COVID, coming from the Russian-Ukraine war, the trade, supply flow are beginning to stabilize. These are also things that could contribute to the global inflationary trend for the second half of 2024. And we believe that the global trade scene also would continue to improve. If we continue to see increased demand from China, which is a key player in the global trade scene, we believe that this will of course mean that commodity prices might continue to fall, as even the Chinese economy is beginning to participate, better in the global trade scene, coming from restrictions for the COVID-19 that we saw 2022 or even in the early part of 2023. And we expect, of course, global growth and global trade and even global inflation to continue to improve for the second half of the year. So that just means that our outlook for the global economy is somewhat positive. We believe that growth will be strong, for the second half of the year. We expect the disinflation trend to continue, and we will expect to see significant enhancement in the global trade scene. But coming to Sub-Saharan Africa, one major thing that has characterized the region has been high debt levels, coming from COVID, when countries had to increase spending to stimulate the economy when economic activities were stagnant. We saw that companies had to increase fiscal spending, despite the fact that they've typically not been able to meet up with revenue generation. So the fact that they are increasing spending while revenue is not even meeting up to their targets meant that these companies, or these countries rather, they had to raise debt to be able to fund fiscal budgets. And this just means that the debt profile for these countries were increasing. And when we saw the fact that inflation was high across economies, interest rates had to get high, it just meant that the cost of servicing this debt also increased for this country. And this is what prompted the defaults that we've seen some countries in the Sub-Saharan Africa. We've seen Zambia, we've seen Ghana defaults in their debt obligations to international creditors. And the thing was, or the expectation was, that we might even see maybe other African countries who have pending debt obligations like Kenya. There was a fear of these countries. However, we saw that even for Zambia, even for Ghana, they've been able to reach like a restructuring agreements with their international creditors. They've been able to restructure these debt arrangements to sort of provide a temporary relief and gives them, the opportunity to actually strategize better. And we saw that, improved participation or improved intervention from multilateral organizations like the IMF has also been another thing that has helped these restructuring programs. And seeing that these countries, they have high debt levels currently, and there's even a probability that they might not be able to meet up with revenue projections in the near term. We believe that here we might still continue to see high debt levels around the environment, but there is a positive for the Sub-Saharan region. We saw that during the first half of the year, global growth across the Sub-Saharan region for some major countries were actually improving. We saw countries like Kenya, we saw countries like Kenya, and even maybe Kenya and one other country, they recorded improved economic growth due to the fact that the oil sector for some of these countries have been improving, and due to the significant inflows that some of these countries even they recorded due to interventions from maybe the IMF during that period. We saw that the fact that interest rates in the sub-Saharan region were even higher than when you compare to the global economy. It was another thing that just incentivized inflows into the sub-Saharan region. And this just meant that some of these countries might be looking forward to seeing less volatility in their currency rates. And what does that mean? It means that due to the fact that rates are high, it might translate to higher yield for their instruments. And it just makes instruments for this region more appealing for international investors who want to bring in their funds into the region to take advantage of these high yields to make more money. And this will mean, of course, that foreign inflows will be coming into the region. Of course, that's what we expect. And this is something that could improve liquidity in the foreign exchange market of these countries, and maybe lead to less volatility, or even in the good case or in the best case scenario, stability in the foreign currency or in the exchange rate situation of some of these countries. Also, we saw that Kenya, Cote d'Ivoire, and Benin, they returned to the international debt markets, issuing Eurobonds during the first half of the year. And surprisingly, the reception was quite good, as we saw two of these instruments actually record oversubscription. What does that mean? It means that investors are beginning to be more optimistic about growth prospects in this region. It means that investors are beginning to see maybe a light at the end of the tunnel or brighter prospects for this region. And it just means that investors are willing to bring in their funds to invest or to buy instruments of these countries. And we believe that in the near term we'll continue to see occurrences of such. We believe that even the Nigerian government has hinted at the possibility of a Eurobond issuance in the second half of the year, and that means that we'll continue to see significant foreign exchange inflow into the region, and this could of course help spur economic growth if these investments are, they are put into productive activities that is able to bolster economic growth for this region. And then coming down to Nigeria, which is the major economy that everybody's looking to, hear about. We saw that in Q1 2024, growth was sustained. Nigeria sustained its growth improvement or its growth momentum. The economy increased or grew by 2.98%. And we had different contributors to the growth. Looking at the oil sector, we saw that the country recorded improvements in its oil production volumes to around 1.5 million barrels per day in the first quarter. And that was significant. That was higher than what we saw in Q1 2023, and even higher than what we saw in Q4 2023. And we believe that factors that have contributed to this improvement in oil production volumes include the increased surveillance and security that the government has implemented across oil infrastructures. We also believe the fact that some terminals that were unoperational, last year, they began operation during the first half of this year. And these are factors that just drove the improvements in our oil production volumes that we saw. And for the non-oil sector, we saw that it was a tale of mixed fortune for the non-oil sector. While we had sectors like the manufacturing, the telecoms that were battling with high interest rates, FX, depreciation, they were battling with inflationary pressures, which impacts their investment capabilities and of course constrains production activities. We saw and these sectors, as a result of this, they recorded moderate growth in the first quarter of the year. But we saw that for sectors like the financial services and even the transport, the reverse was the case for them. These sectors could benefit from the depreciation of the naira against the dollar, and it even helps them to improve, revaluation gains, and it just contributed in stronger economic performance for this sector. And on a net of factors, of course, we continue to record growth as an economy. But going forward, what do we expect? We think we'll continue to see, or we will find that we will continue to see growth in the oil sector. And that is premised on the fact that we believe oil production volumes will still increase. First off, we've seen that the government has signed a lot of agreements with other countries like Germany, with Saudi Arabia. They've signed agreements with international companies to improve, investment in the oil sector. And this is one thing that we expect to actually drive improved volumes. Also, we've seen that, we've seen local or indigenous companies in the oil sector come to take up onshore and offshore properties of companies that are about to divest from Nigeria. So when these terminals become operational, of course, we expect to see them contribute more to the total oil production volumes for the country. However, we believe that we might not see so much improvement in oil revenue. And that's because there's been, a subtle sort of subsidy payments for the Nigerian government. So if part of these oil proceeds are going for an unofficial subsidy payment, it just reduces the net oil receipts that we get as a country. But on the net of factor, we expect improvements for the oil sector. And looking at the non-oil sector, we believe that some of the factors that sort of tempered growth for the non-oil sector, for specific sectors rather, like the telecoms that I mentioned, the manufacturing sector, we believe that these factors are still very much existent. We believe that the naira to dollar, will still continue to stay around the same levels. Inflationary pressures are still very much existent. And even poor infrastructure, which has been something that has been impacting production activities for countries or companies in this sector, might continue to play out, and we might continue to see moderate growth for these sectors of the non-oil sector. However, looking at financial services, we expect them to still continue to record strong performance. We expect to see improved performance of the mining and quarrying sector. And that is hinged on the fact that in the first half of the year, we saw the government issue new licenses for some mining companies. And this will just improve participation in that sector and could lead to more outputs from this sector. So on a net of factors, we believe the economy will record stronger growth in the second half of the year, and we predict a GDP growth of 3.14% for 2024 full year. And then coming to inflation, which has been a major topic in the Nigerian economy for the past 1.5 years, we saw that inflation remained on the rise in the first half of this year. As of June 2024, inflation increased for the 18th consecutive time to 34.19%. And we know drivers of this, like we've mentioned, in earlier reports, would be the fact that the food index, which is a major contributing factor to our headline index, is the food sector is experiencing a lot of challenges. We've seen insecurity in food producing areas, which is a factor that has impacted yield from the food sector, from the agricultural sector. And when the supply is not as optimal as it should be, it just really translates into higher prices. Another key factor that has plagued the food sector has been bad transportation network. Transporting some of these agricultural products from the farm to the market has been a challenge. And it's another thing that adds a layer of cost for players in this sector, and of course it's transferred to consumers. And also we've seen the FX, which is the major topic in the Nigerian economy for now. The FX has led to the increase in importation costs. And when you look at the fact that Nigeria is a highly import-dependent country, we import a lot of items that are consumed in the economy. So when exchange rate is high, it increases importation costs, and these costs are indirectly passed to consumers. And this is another contributing factor to the high price levels that we've seen in the economy. However, we also note that another thing that has contributed the inflation figures that we have seen in the economy will be the high interest rate environment, which has meant that borrowing costs for companies are high, and sometimes they have to pass on this cost on some of their products. And it's another thing that contributes to high price levels. And what is our outlook for inflation? First off, we saw the monetary policy in the first half of the year, come up with different measures to curtail inflation figures and to make sure that the yield environment aligns with the interest rates. and we've seen them implement like a 50 basis point hike, a cumulative 750 basis point hike in the monetary policy rates. And what has this achieved actually? This has achieved some of its targets. We've seen that this has incentivized foreign inflows into the economy because investors are seeing that our instruments, seeing that not only did they implement, rate hike, we also saw the effects on the use of domestic, fixed income instruments. And this just means that yields and returns for investments in the economy was very attractive for foreign investors. And this is something that contributed to significant inflows into our, economy. And when I say inflows, foreign currency inflows, and this improves liquidity in our foreign currency markets. And this sort of meant that towards the second quarter of the year, we saw a relatively stable FX market. And, all these were things that were achieved, by policy measures implemented by the monetary policy. Going forward, we believe that the country might be seeing, moderation in its inflation figures. Now, note that I said inflation figures and not inflation pressures. Okay, so there are factors that we believe could contribute to, a reduction in inflation figures. First off, we've seen the fiscal side come up with policies like suspending import duties on food items. We've seen them, start programs like the all year round farming of certain key food staple items like maize, rice, wheat in the economy. And we believe that when we begin to see the gains on some of these ventures, it might actually contribute to higher agricultural productivity in Nigeria, and this could translate into lower prices of food items in the mid-term. However, the fact that FX has been relatively stable, is another thing that would expect to contribute to moderation in inflation figures. Another thing that could lead to the disinflation trend that we're expecting would be the fact that there's a high base effect. Inflation going from June last year to July this year, there was like a notable jump, and that means inflation figures as of the second half of last year were already high. So when you calculate the year-on-year changes, you begin to see a moderation in the figures that we will see, not because prices of general goods and services in the economy are suddenly declining. We might actually see, easing in the prices of some certain items, but we don't expect it to be broad-based. We might still continue to see, prevalent inflationary pressures in the economy. However, inflation figures will start to moderate, and we've come up with, a projection of around 29.15% for inflation by the end of the year, by December 2024. And then, moving to the fiscal policy, Nigeria, like every other sub-Saharan African, like I mentioned earlier, they've had to rely on debts as, typically these countries, they don't meet up with their revenue targets. However, we saw that in 2023 full year, Nigeria actually exceeded its revenue targets for the first time in 10 years. And well, when you take a closer look, we'll notice that the major factor that contributed to this would be inflows, revenue from grants and donations. And of course, this is not a sustainable practice. So although we were able to, meet target for 2023 full year, we don't expect that to continue to happen because the country will not just continue to see inflows from donors every year. So we expect that if we are not able to meet revenue targets, especially with the fact that some projections that, there's some assumptions that were made to even arrive at these revenue projections have not been met. There was the assumption of a 1.78 million barrel per day oil production, which we have not been able to meet yet. So it just means there's going to be a significant shortfall in revenue from oil. Also, looking at the fact that the federal government trying to ease inflationary pressures, suspended import duties on some food items, which is another avenue that the country makes revenue from. We might see, moderation in the revenue figures that will be coming from that avenue, and it means that the country might not be able to meet up with revenue target for 2024. So, of course, we expect that the government will still, implement, come to the debt markets to, get domestic borrowings to be able to meet up with fiscal deficits. And looking at Nigeria, like every other sub-Saharan Africa that I mentioned, debt levels have been high. We saw that in Q1 2024, our debt profile rose to around 121 trillion, and coming from around 90 trillion in December 2024. The contributors to this figure has been, increased domestic borrowing as the government tries to meet up with budget deficits. through borrowings in the local economy. We also saw that the depreciation of the naira that happened in the first quarter contributed to, higher foreign, debt balances, and it just culminated in higher debt burden for the economy. And we actually believe that this would continue in the near term. As the country continues to, fall short of its revenue projections, there's the need for the government to, resort to borrowing to be able to meet up with its, expenditures, the planned capital expenditures. And we already see that we've seen that actually come into play. The country has access to loan from, certain agencies like the AFREXIM, the oil-backed loan from AFREXIM. We've also seen the country try to, access loan from even successfully access loan from the World Bank. And all this, of course, would mean that debt figures are going higher for the country. And we believe that in the near term, it will just continue in that trend. And now, speaking to the external sector, which has been a very eventful sector of the economy, we saw that, there were some positives in the external sector. Foreign trade was, positively was significantly higher at around 31 trillion naira, because we saw that the value of export increased to around 19 trillion. And what drove this was, of course, the improvements that we saw in our oil figures, seeing that oil is a major, constituent of our export volumes. We also saw that oil prices were relatively, better during the period. And then the impact of the depreciation of the naira, which increases the value of our exports when, converted to naira, was another thing that drove the improvements in foreign trade. And we expect that to continue. First of our expectation of improvements in oil volumes, it just supports this outlook. And then when you look at the fact that we might see, non-oil exports, if we're able to see non-oil export actually, come up to, this is another thing that could lead to an increase in foreign trade and would probably lead us to, maintain this current surplus position that the country is already in. And when you look at capital importation, like the monetary policy tried to achieve, we saw that the increase in the NPR led to significant inflows into the economy in form of FPIs, and we saw our capital importation go to around $3.5 billion. So going forward, we think that this would continue if the yield environment continues to stay around the levels that it is. And if we see advanced economies actually cut rate, this could just mean that our instruments will continue to appeal to investors and maintain, inflows into the economy. Then, speaking to our external reserves, although we saw that the reserves depleted, around March, the first quarter of the year, due to the fact that the federal government had to settle FX backlogs, they had to settle some of their ways and means obligations. It led to a serious depletion in our external reserves. But due to the fact that we saw increased remittances and we also saw inflows from, loans and other things, it just improved the external reserves to an extent. And we saw that as of June, foreign reserves was around $34 billion. Now, finally, speaking to exchange rates, the country's exchange rate has, since the devaluation of the naira that we saw last year, the naira has been on a free flow against the dollar. Coming into the year, we saw that the naira went as high as 1,800 in the first quarter of the year. And, what's due to the measures that the monetary policy has implemented that I've explained earlier, and the liquidity that improved in the foreign exchange markets, we've actually seen a sort of stability in the FX market in the second quarter of the year. And our analysis even show that, the naira was the most stable in June 2024. It recorded less volatility in June compared to other months of the year. And going forward, we actually expect to continue to see this relatively stable foreign exchange market. Our expectation is hinged on the fact that we expect the Monetary Policy Authority to maintain its, stance, its hawkish stance, to see hike rates by around 100 to 150 basis points this year in H2 2024. And this will mean that the yield environment will still remain a bit high, and investors will still be, they will still be inclined to bring in money into the economy, which would, speak to the supply aspect of foreign exchange. And then we believe that with the improvement of oil volumes, which increases our oil receipts, if we see oil prices stay relatively stable, all this will just mean that there's enough supply of the dollar in the markets, and it would actually lead to relatively stable, exchange rate figures for us. Also, we've noticed that, it looks like the CBN is actually also comfortable with leaving the FX at around 1.5 figures. seeing that when we've seen occasional swings in the markets, but we've also seen the CBN come to the market to sell dollars to BDCs to improve liquidity in those periods. And we believe we'll continue to see them do that in the near term. However, it's good to note that while all these results, all these improvements have come from monetary policy actions, they are just temporary fixes. And the fiscal authority needs to come up with, reforms that will support these actions from the monetary policy. If we're able to improve, security conditions in the country, it might just incentivize foreign direct inflows, which would be investment in business, in the economy. And this is something that is more sustainable. This is how you get, more sustainable inflows, and it will lead to increased productivity in the economy. We also believe that if the fiscal policy is able to, address infrastructural deficiency like power supply, road networks, these actions would be what will lead to a more sustainable appreciation of the naira. However, we at Meristem Research, we've come up with a projection of around 1,515 naira as our base case scenario for the naira to a dollar by the end of 2024. Thank you very much.
That was really impressive. Felicia, well done. Please keep your applause going. Underrated. They really stand there with no notes for 25 minutes and give you a full rundown from the global perspective. All that was really good stuff. Really good stuff. We might as well go home because she covered everything, okay? But we still have to, of course, have our fantastic panel, which I'm very much looking forward to. So, ladies and gentlemen, we're going to get right into it. This is I'm an economics graduate, so every university, my favorite department is the economics department. So please, a round of applause for Professor Femi Shoaibu, who of course is the Department of Economics at the University of Lagos. Professor, please come right up and take a seat. We'd love to hear your thoughts on what's going on around our dear country. Thank you so much, sir. All right, up next, one of my favorite analysts to come on my show. I'm always disturbing her. When she can't make it, she sends somebody equally solid to come and answer my questions. The head of research at Meristem Securities, Praise has been here. Great. Everyone at Rise loves Praise because they love our insights all the time. Okay, up next, please welcome the Managing Director of Meristem Stockbrokers Limited, Mr. Saeed Bakshi. Star-studded panel, star-studded. And last, definitely not least, Okemute Isagwa, who is the head of Treasury, Meristem. You're very welcome. Okay, yes, our other microphone. Professor, you're going first. So we heard Felicia going into the monetary policy environment. There's been a whole lot of debates around whether or not the monetary policy plan has had any effect, any impact. Wanted to first get your thoughts there. What's your take on the monetary policy path, the 750 basis point hike that we've seen so far?
Yeah, first of all, let me appreciate Meristem for giving me this opportunity to participate in this program, and also for the great job they're doing in the market. I always follow the outcomes from the incumbent, and also my boss there, Saeed Bashir, for the opportunity and praise and everybody here, and also the presenter. She did excellent work, and indeed, I have a slide that I thought I used before with almost everything that I wrote there. That is, but there are some areas where I absolutely disagree. Yeah. So coming to the situation we find ourselves in Nigeria today. Now, monetary policy for the first half of the year has been very active, very, very active, aggressively active. And as a result of that, we have interest rates going up beyond even most of the predictions. And again, the Monetary Policy Authority taking some actions that even beat most of the predictions as well. And what's the consequence of that? We have a monetary outcomes where we have liquidity being constrained as expected. But unfortunately, the outcomes we were expecting was inflation also to stabilize, to come down. But instead, we have even higher inflation, even than what is predicted. So that's a something that we'll be worried about, because the ultimate goal of any monetary policy is to stabilize price, to boost confidence in financial instruments, and people to be able to invest in sectors. So, but when investors, both financial and others, are really skeptical about the direction of government policy, then we begin to create problems. So I see the first half of the year having an active monetary policy, but not having impact on the financial indicators. So I feel that governments have more than one objectives, and the key one that cannot be measured directly is trust and confidence in policies of government, credibility. When people do not believe government policy, it can never be effective. And what makes policy to be credible and trustworthy is for it to be predictable. That this way they are going at a point after the first quarter, we expect government to go this line. Once you can do that, then we can plan and we can also advocate, and then people find out in this direction. But when we begin to speculate what the CBN will do, begin to create several scenarios of government, automatically, whichever one comes to pass, definitely people will not believe it. So I think governments need to work on become more stable and they begin predictable. And in a program I attended recently, I made a case that we have too much active monetary policy. How do I mean? That it's only in Nigeria you begin to wait for government, for MPC to hold their meeting. And you can track our indicators. Everything, after that period, everything go elsewhere because people begin to wait for money in CBN 12 times in a year. And that's really a distortion every time. When there's a delay, every system becomes stopped. When they give outcomes that's not in line with projections, the system gets disrupted. So I think if CBN will find another alternative way that will not create that tension in the system, we could have a credible policy. Then we also, as in the investing community, we also again need to find out what are the structural factors that drives our money policy. I think it's beyond financials and it's beyond technical issues. So we need to go into fundamental factors. And because monetary policy generally in Nigeria had been, the monetary policy authority in Nigeria look at the system more from demand side problem. And they continue to contain aggregate demand, believing that our problem is that we have excessive demand, whereas not excessive demand. So what we have is shortage of supply. And therefore, the gap there, we are addressing it. So demand is even low, but supply is lower. So the only way we need to do to bridge is that to work on supply side. But when we constrain demand, believing that the process of demand, we are adding more to the costs. Because both the investors, the producers, and the consumers go to the markets to buy and bear the cost to consumer. So rather than taming the inflation, we continue to also aggravate the problems. I think we need to look around that area.
Okay, so just a quick follow-up. There's monetary policy meeting next week, which you said all of us will be waiting for, and just something. What do you expect from next week? I think 27th.
Well, for 2 consecutive times now, the monetary policy raised the rates, and for me, I expect them to also tame the rates. At least if they cannot reduce, they should keep it as it is currently now, so that way we will be building confidence in the system.
Thank you, Professor. So, Chris, monetary policy, of course, has an impact on the exchange rate. Felicia was talking about the amount of money that come in based on rates being high enough to attract, FX inflows into the country, even though they're temporary. As far as the exchange rates is concerned, what's the outlook there? What do we expect? Are we going to stick at this level or dip up and down? How are we seeing things?
So I think the main thing that is expected, especially on listening to Felicia's presentation, we are largely expecting more stability from the exchange rates sector. I mean, the CBN as the Monetary Authority has used a lot of arsenals. You know, the first half of the year was, like Prof said, it was more very active monetary policy environment. There was a lot of circulars coming in, talking about the circulars directed to the banks, the oil and gas sectors, the BDCs. It was circular galore. And then not just the circulars, there's been the OMO auctions, there's been rates, increase in interest rates, and a lot of measures that the monetary policy has taken in the first half. And we think that they have largely used a lot of the tricks in the hat. So right now, there really isn't so much leg room to navigate in terms of achieving significant exchange rate appreciation. So what we're likely to have is to see the monetary policy and the CBN try to maintain stability around the exchange rates around the 1,500 to 1,600 levels. And I think as at this morning, we're seeing it at 1,600. And but speaking to market traders and FX, even speculators in the market, most people are expecting it to bounce back to 1,500 at some point, you know, in because of 1 or 2 weeks. So I think that's like the comfort level in the near term. But beyond the near term, you know, there's also the need to consider what can lead to either appreciation or depreciation going beyond this near term. We think that the fiscal policy, the fiscal authority needs to create a lot of room in the external sector, trade, to be able to create, you know, the more FX inflows into Nigeria that can create sustainable exchange rates appreciation, appreciation of the naira. So for the next 6 to 9 months, we would largely see that much appreciation. However, you know, there are things that you don't foresee, just like nobody saw COVID coming. So hopefully things like that don't happen again. But if we should have, because of how very unstable the current environment is, any significant shock would definitely topple the exchange rate, and then, you know, see that so we'll come back to this conversation again and be having a worse prediction.
All right, thank you so much. Speaking of COVID, US President Joe Biden, we heard he got COVID again and couldn't attend an event. So pretty interesting. Mr. Bashir, let me come to you. Sectors, so far the equities market, we've seen the appreciation in a handful of stocks so far in the first half of the year. How do you see things in the second half in terms of which sectors might perform as far as stocks are concerned?
Yeah, thank you so much. In the first half of the year, if you see, as we speak, for the first half of the year, the level of return was about 34% cumulatively. And if you decompose what happened in the first half of the year, you will see that most of those gains were concentrated in January. That is the first month of the year. Market was negative in February. In March, it was negative. In April, slight, upward in terms of return. And of course, in May, market went down about 6 or 7%. In June, market was almost flat. So looking at it in the first quarter of the year, market was positive. In the second quarter of the year, market was negative largely. And it was essentially driven by the activities of the foreign investors, which came around April, May, June. In fact, from the data released by the NGX, Nigerian Exchange Limited, it showed a significant upward increment in the participation of the foreign investor from below 10%. If you look at the contributions or the participation of the foreign guys to the locals, it was a mix of, it was 110% before or by the end of December 2023. But we saw a significant improvement, perhaps because there was some level of stability. So you can see the connection or interconnectedness between the exchange rates and our markets. So we see some level of stability in exchange rates, and a lot of the backlog that were cleared by the CBN in terms of FX backlog, that also reinforced the confidence of the international community in the markets. And we saw a lot of foreign investors taking position. Also, the foreign participation moved from about below 10% when we closed the year in 2023 to up to about 40% by the end of June. And that is quite significant if you look at it. And so largely, market has been quiet. The gains that we saw so far in the market, especially up to the second half of the fourth half of the year, June, was what happened in January, which was building on what happened in December. There was a lot of enthusiasm and the rest. And of course, we are not, the depreciation or the devaluation hadn't happened. Naira closed around 1,200 thereabouts at the year. And of course, when the monetary policy authorities started hiking the rates, the hawkish stance, and from below 19%, 18.75 when we closed the year, that was the NPR, up to they have raised the rate 3 times by 750 basis points, which has taken us to close to 27%. And that has affected equity. So that tells you the inverse relationship between equities and most especially the fixed income. A lot of funds, a lot of activities left equity. They went to this.
See what Kim would say.
Exactly. So she took the money away from my markets. You know, I'm an equity guy, and so that is what we are seeing in the markets. So going forward, we are seeing stability in the fixed income markets, and which, according to all the research, the data has shown us that we will see more stability going into the second half of the year, and most likely towards the end of the year at around 1,500 or 1,515, you know. And if that is the case, that would also mean that perhaps we'll see some level of stability in the market. But the other challenge is that, which I'm not happy about, which is what Felicia presented, that the research, because there's a barrier between myself and the research. You know, the way you consume research is the way I consume their research too. I don't dictate what they do. I'm not happy because she said they are expecting the monetary policy authority to also hike another hike of about 150 basis points. That is a disincentive to me. I'm an equity guy. And what do I tell my clients? I want activities to return back to my markets such that I can improve, I can further grow the wealth of my clients. So that is what we are looking at. So we expect that our expectation, our wish is that the monetary policy authority would take out the rates. We don't want to see our hike in rates subsequently, such that we can have some level of stability in the market. But be that as it may, there would be drivers. Before I talk about what the expectations are in the second half of the year, I would say that looking at the drivers of the markets, currently we have banks, three banks are already in the market. We have Fidelity Bank with their hybrid offer, public offer and the rights. We have Access Bank with their rights. Then we have GT Bank with their public offer. A lot of other banks are coming. All the banks are coming. Going by the CBN regulation, they are recapitalizing. So bank recapitalization is a plus for the market. It will generate activities in the markets. So that is a driver that would bring about more participation in the market. And I can tell you for free, from our own data, we have seen a lot of new investors coming into equities markets. So from our own data in terms of client acquisition, what we do now, it's like 3 times what we have done, what we normally do on a daily basis in terms of new clients that we onboard. And a lot of new investors who are currently coming into the market, or people who have started the market since 2008 when there was global market crash. They are not come back. Now they have an opportunity to participate in public offerings. So they are coming back into the market, which is a plus for us. And we have the facility, we have infrastructure to onboard those clients. So that makes me happy. So apart from the banking recapitalization, we have a lot of other activities. So FX stability would also mean that our market would give a sign of relief. So if we do not see further devaluation of currency, that will give some level of stability, which is what Pro spoke to the other time. Investors don't like uncertainty. what they can manage is risk. They have models to manage risk. But to manage uncertainty, that's quite difficult. So we expect that all these activities put together, and as inflation tapers, which they also spoke to inflation, that they see inflation due to base effects, inflation will come around below 30%, which is a good news for everyone. And as inflation tapers, and the discretionary income of investors it makes more sense for investors, and that's in a way will also be well for equities market. Of course, there are other factors we also bring into that inflation. Minimum wage conversation is on the table, and you know that when there is minimum wage, you know what that will also be in terms of inflation. But it's the conversation I don't want to delve into now. So
Yeah.
on a balance of scale, we see more activities in the markets in the second half of the year, and that should market should close perhaps close to 40% by the end of the year. Thank you.
Thank you. Okay, Praise, we talked about this earlier. As you mentioned the market, I said let me go in because there's something that happened between yesterday and this morning.
Yeah.
And that was the administration announcing that they are looking to raise 6 trillion naira and tax the FX gains of banks. I said, let me just hop into the market now using the Meristem app. And that's everybody out there use the Meristem app.
Very
to check the markets, right?
Yes.
Zenith is down 3%, UBA down 2%, GTO down 5%. I mean, the banks are just FCMB down 3.2, FBNH down. So it's crazy. I don't even want to take this off. The impact of this decision to tax the FX realization gains of the banks. I will have to get your thoughts.
Yes, I mean, the decision to tax, it's called a windfall tax. The tax that the government implements when the sector say gains unfairly about for something that happens in the economy. So that's just basically tax. The federal government is deciding to implement a 50% tax on the realized gains of banks FX revaluation from last year. We know that a lot of banks actually realized a lot of gains from revaluation, and then it just also speaks to the fact that we are going to expect the banks to have a higher effective tax rates for this year. Normally, banks' effective tax rates, is around 31-32%. But with this extra 50% windfall tax on their FX gains, it should push up their effective tax about 45-50% from 31. So I can just give a band of 40 to 50 because it will differ by banks. And it's just in line with the federal government drive to be able to raise more revenue. The ability to source the entire 6 trillion from just that alone is quite shaky, because even realized and unrealized gains from banks last year from all the banks was about 1.6 trillion. So taxing that might not necessarily give the 6.2 trillion as expected, but it's a step that the federal government is deciding to take to be able to raise the funds they need. They need about 6 trillion, 3 trillion for recurrent expenditure, 3.2 for capital expenditure. Of course, also noting there that about 50% of the money they're trying to raise is for recurrent expenditure, which is an unproductive spending. So that is also still going to have further impact. It means we should even expect more borrowings from the fixed income market. So committee is likely still going to eat good. Well, yeah, it will just mean more tax for and investors are definitely repricing, putting that expectation, because also it's going to affect value. It's also going to impact valuation for all these banks. You're having higher tax, definitely your net profits reduces, and then that impacts the valuation for the banks for this year and even to the long run. So it's just basically investors are definitely going to price that in, and maybe that's one of the reasons why you are seeing your 3% down on all the stocks.
Thank you so much. Okay, to you now. It looks like maybe all this money pulling out of equities is going to flow to you. So, which shows you that wherever you're going, you can talk to Meristem, right? Fixed income equities, wherever it is. So, okay, your take on what you've seen so far in half year with fixed income yields, and I guess with all this new news coming in, how you see things moving forward.
All right, thank you very much. As has been said by almost everyone, that there's been significant hikes in the first half of the year. We saw 750 basis points increase in the NPR, and that dovetailed into the market, into the yields in the market, which is one thing this current monetary policy has been able to achieve. Previously, there's a disconnect between monetary policy rates and market yields, but right now that has been corrected with these monetary policy authorities giving clear signals about what they're targeting: inflation, FX stability, price stability. It's very clear. And I think they've been able to achieve some results there. Are we there yet? Definitely not. There needs to be a lot more collaboration between the monetary and the fiscal. The monetary is in overdrive, but we're not seeing that same passion from the fiscal side. I guess trying to tax banks is one of their ways of trying to raise funds, but we need much more than that in terms of structural improvements, security, infrastructure. There's so much more that needs to be done. Corruption, there's a lot that needs to be done. But coming to fixed income yields, right, the market has been very active with yields above 20% levels. That's really juicy for investors. So we've seen an influx of investors into the fixed income space, both domestic investors and foreign investors. And we expect that to continue, basically, because obviously the inflation target has not been met. We've still seen uptick in inflation. So I don't think that they are ready for a hold yet, even though that's what market wants, but they might just be constrained to further hike the rates, maybe just one more time before we get to the hold. So where do we see, how would this affect the market? Possibly 100 basis points, 50 basis points. I don't know how aggressive it's going to be, but in my opinion, yields will remain elevated for the rest of the year. So I invite everybody, all of you, up to my market. The equity market obviously has a lot of opportunities as well. So you could diversify, take advantage of this market and that market. Treasury bills, all-time highs, bonds, commercial papers, even our mutual funds are doing very well. So those are some of the options that investors can take advantage of in that space. Thank you.
Thank you so much, Kemi. Prof, let me come back to you. I think you mentioned the rice distribution. Did you? The trucks of, how many is it? 2,000 bags of rice. Anyway, fiscal policies, I want to ask you about the fiscal side. Because we talked a lot about monetary policy. As far as balancing things out, what do you want to see from the fiscal authorities? And funny enough, I mean, fiscal policies are about taxing, right? So maybe that's where this bank thing comes in. But I want to get your thoughts on the fiscal side, what they need to be doing to complement what the monetary policy side is doing.
Yeah, thank you. But before I go to fiscal policy, I have one or two things to add to what has been said. I think from my friend here is afraid of the fixed income. I think there's a lot of, there's need for us to do a lot in the equity markets. I personally withdrew from the market. Yeah.
Customers. You have a customer.
I will explain. When in 2008, when the banking offer came up, I invested all my wife's money and part of my children's money into one of the banks that failed. So from 14 naira, maybe you know the bank, died down to 53210. And when it failed, then I have zero equity in the bank. And if I recall back, we're already in another time of the capitalization. So how someone like me who still carry the scare in my body, even the heel, it has healed. Anytime I raise my hand and look at my asset, I remember I was a victim. So what are we doing? Now, not just maybe, and the money you are raising is not even to the public in recent. It's the right issues, it's existing people are buying, you are not really bringing in new people to the market. Two, we need to do things. We need to educate and create awareness. You need to build confidence back and tell people, no, this is not 2008, it's 2024. A lot have changed. A new mechanism has been built, that framework that will not allow a bank to fail absolutely as it was in that period. Number two, even those that we experience again, it's not that it's totally failed, that the CBN is coming up with a way of ensuring those who have funded are not going to suffer. So we are not seeing that kind of conversation, and you ask them to bring their money and go. So we just have to get that clear. And two,
I was going to come to you for your response, but
aspect of the making that maybe the fixed income will be better. I think the CBN is trying to drive a way to get real interest rates for the president. I think that's what they're doing. And the more they push that, the more they push inflation higher, and the more they create discomfort for the people. So as we know, so I think what we need to do currently now, and I said, is to build confidence and trust. And if some bank realize that they are going to make money from forex, then they were not aware that that gains will be taken away from them. Now you are coming. So why are they not aware earlier enough that they are going to be windfall tax? If from the beginning, when they are introducing their, at least manipulating the forex, they now inform the bank that, oh, you are likely to make the amount of money, but you are going to tax you from the beginning. They will have worked that into their system. Now, if I'm a banker now, or I'm now being informed that, oh, if government comes up with the policies that are going to be beneficial to me, I'm going to be penalized later. So that's the meaning. So I think we need to build confidence. Policy trust will be able to be clean and clear from the beginning. Not after actions have been taken, you now realize who you have to come in. So that's what I meant by at least confidence building and consensus as well. It should not be somebody imposing it. So that's about that. Now come to fiscal policy. And still come back from the argument of monetary policy. In any system, the driver of the economy is the fiscal sector, not the monetary sector. But in Nigeria, for whatever reason we have, CBN is usurping the power of the Ministry of Finance. And it's only in Nigeria you will hear more from the monetary authorities than the fiscal policy. And they are simply, in their acts, in their objects, they are just advisor and banker to the government, not necessarily the mouthpiece of government. We hear more about what government is doing from Central Bank governor than from the Minister of Finance. Many of us don't know if the Minister of Finance is today. We don't know. So, and whereas that is the president or Minister of Economic and Budget, those are the people we need to hear them regularly to give a direction of government. The CBN to act under them, give them advice. You don't hear your advisor. Is in Nigeria, you advisors speak more than you because they're being advised. And that's the problem. So we are saying no matter what leads to them become more active, they should go back to the national banking system where we hear them from the presidency, from their home. So if they do that, much of the inflationary pressure we have now will go down. Because much more, because every day we wake up for what CBN we see and begin to disrupt our planning, our thinking, our psyche. And that's so the monetary authority will be challenged currently now. As of today, we know the level of unemployment, so we know the level of poverty, we know the level of insecurity, and therefore government, the fiscal policy will be more aggressive and more at least involved. Now the 6.7 million children they are bringing on board, more than half of it is going to be correct. And my sister said it's unproductive. Actually, it's productive. Because to enhance demand is to empower people to be able to buy alcohol. It's going to be part of me as well because maybe when they produce the minimum, I have more power to buy and I also be able to buy shares. So yes, so I am very sure now such money by having increased my salary now is not going to go for food. For some people already meet the minimum food in Ukraine. So it's going to come to equity where I'm not going to fix income. So I'm going to equity because I know that's go. So because it's cheaper now to go to the so let us look at it now. We are the banking also the finance is going to benefit from this and this increment because much of the deal will now go to that, especially when the banks are recapitalizing when such money is going to be released to the system. So it's going to be so it's not totally unproductive. It's going to drive. And why are they doing that? They realize that the purchasing power is getting reduced as inflation getting higher. So since we cannot power the supply, then we have to power demand to also power the supply indirectly. So it's now creates a problem. The CBN is putting pressure downward. The fiscal policy is releasing the pressure upward. And therefore there's need for continuation. And what are you doing now so that we know what to do so that we not counter your efforts? So the fiscal policy have to move hard. The idea of giving people palliatives cannot solve Nigeria. You don't buy your way out of poverty. You walk your way out of poverty. How do we do that? What kind of skills do we do it? And I am arguing that in Nigeria today, we are investing in technology that make us to become more vulnerable. We are empowering people to be able to build web page, to build apps that make Nigeria to buy from foreign country, not to buy from Nigeria. We are empowering people again to create financial and fintech technology that make people to transfer Nigerian money overseas. We are not building capacity to build small commodities, part of what we are using teams. And so I think it's the federal government direct their fiscal spending to building capacity of people, to build local capacity that can build local products that can make us enjoy the global value chain and create values, not just adding value to existing. But what we have now, we want to create, like I said, the SME policy of government, small and middle scale development. Government will say we are going to create 1 million entrepreneurs. We already have the middle scale industry is already saturated. We already have enough business owners in all sectors. How do we grow the existing one, not creating new one? And we are creating more competition when people, the mortality of SMEs is at higher level. So now what do we do? How do we scale up existing SMEs? The small one to come to million and four. We did a study, we are going to release it again now. Now the SMEs are dying and we are creating new one. And if everybody says want to become an entrepreneur, who will be worker? If you're all entrepreneur, this whole place will not be paid off. Because some people are natural to become entrepreneur. And we need to have people who are skilled to be able to work in industries. People who can become innovator, who can introduce new technology. So government have to come directly into establishing partner with private sectors to build industries that can produce some things. So not that maybe just releasing money to the poor, the vulnerables. The more they do that, it creates lazy economy. Where people say, oh, when I am not having jobs, when I'm in the village, government will give me palliatives. So, and therefore, it's really public. So I think government should direct their policies to, and look at it. My university now, if you look out because of the ingenuity of university management, our university will have been closed down because of our ability not to meet up with the electricity bill. Our bill was around 150 million per month. Now jumped to 320 million per month. And those funds
a year
per month, not per year. Yes, per month, per year, jumped to because more than double. And yet that money is not from allocation, it's from internal general revenue. Look at what happened in Ibadan yesterday, what happened in Benin. And that is all that we expect in universities. Why is government not tackling electricity problem? Rather than, and if there are issues there, it is fiscal issues, is to resolve it. And it gets Nigeria to have. And you now divide it to band A, band C. And again, you said, okay, you decide. We decide to be band B, you move out automatically to band A. So if the university in Nigeria should go down, you understand what it means. We just got out of a long strike, and then again, this is now institutionally induced crisis in the university. So that's area we seem to go. So it's not about giving some poor people money that will not supply them for the whole day. We should address the bottlenecks in productivity and productive sectors. And two, government should look beyond immediate gains in terms of political outlook. Look at the long-term gains. Just a few years ago, we just finished National Development Plan. Today, nobody heard about it again. Billions of naira and millions of dollars were invested in getting people to get this done. There's no link between current agenda and that development plan. And if that is not functional or working effectively, we can revise it. We can incorporate the renewed agenda into it or use that to do that so that people can see that we have something to track the performance of government. And people can tie their organizational goals towards that. So, and in terms of agriculture, we government need to move from supporting small scale farmers to large scales. From what at least I was taught by Bashir is that there's no economic skill in small. And therefore, if you now say you have, let's say, 1,000 small farmers to produce, the cost they will incur we prefer higher than two, who is doing the two farms who do the same thing. So why don't we migrate from promoting small subsistence farmers to now identify maybe 1,000 farmers, or maybe 1,000 per state or so, and support them heavily in terms of machines, technologies, to produce massively and employ massively, and then be able to bring down costs significantly. It's easy to protect 1,000 farmers in Nigeria than just 5 million farmers. It's easy. So the money, the bandits, if you take it, like, why is Obasanjo Farms is not facing issue of maybe head or something? Because it's easy to manage. So government should look at strategically identify some farmers that they can support massively, that they can produce massively again, and use that to do, rather than now again going back to now making importation of food to be cheaper. After you already empower some people to go and farm. Now, after I produce tomato, you have it easy for people to bring tomato. That what led to the failure of cassava initiative of Obasanjo regime. After people invested heavily in cassava, then before it gets to no policy of taking the cassava produce, they lost. Now people already going back to farms, producing now. You say okay, you remove all tariffs on natural inputs. Automatically, it's easy to import and to produce locally. So that destroys again all the initiatives you have in the agricultural sector. Unless there's no country in the world that's not protecting their agricultural sectors. You can remember the case between China and the US. Now, till today, they are really protecting. So, government have to do the needful and face the hard decisions. Also, if you truly want to use agri to drive the Nigerian economy, then that sector should be a critical sector. And so, I will identify the energy sectors critically, and then again, the agri sectors. And this will now serve to now create our own manufacturing sectors based on what we can get from grid, and then look at which kind of one sector do you want to have in Nigeria. What are those critical products that we import heavily? And then have a kind of conversation with countries where we're importing from, and the company producing that countries, and government get involved, be part of the investors and shareholders, and then they can come and now meet in for raising funds from the stock market to be able to do that. So that is where to go. But a situation where you are complaining that people should use gas to cook in their house, then you are introducing cars that are using gas. And what are you saying? You are reducing the supply of gas. Yesterday, I had a conversation with my student in class when I was talking about electricity. He said almost all the electricity we are using in Nigeria today are power from gas. And gas is becoming very scarce. The little gas we need to cook at home, to power the station, and now we also been taking part of it, taking away to now power electricity, the gas and CNG. So more or less, gas price will also begin to go up without looking at it, and we're having the problem. We just have to agree what to do. So and it's a lot of issues. So government have to come up. They cannot do 8 things at the same time. We can do one thing and get 8 types of results. Thank you.
If you brought around the probably would like to I think he needs to respond to you selling off the stocks in 2008 or so. So sell your market.
I'm sure you know Prof is my teacher.
Thanks for that information.
Okay, so what you said is correct. 2008, 2007, 2008, and I can tell you for facts, I was in research. And very same research was one of those houses that called the market. We saw the market was heading towards the rock. But of course, what happened as a result of the local issues and the global influence. There was a global meltdown in the US, subprime mortgage, and we had our own domestic issues that culminated to what happened. What happened was purely in terms of from the domestic scene. People threw caution into the winds. People were buying sentiment. They were not buying based on information. What drives market? We very we say we don't sell shares. We don't sell securities. What we sell is information, because when we sell to you good information with good or exceptional customer service, That is what grows your wealth. And our promise is that we want to grow your wealth by providing you with up-to-date market information to grow wealth in good time in an atmosphere of transparency. So back to that topic. People were buying, almost everybody was buying shares. And they were not, every share offering, they will always tell you, consult your stockbrokers or financial advisors. Prof didn't tell me, they didn't consult me. So, and it was difficult. Perhaps I would have told him that bank, we do not recommend it. Please don't go there, perhaps. So generally, that was what happened in the market. And yes, it also coincided with, that was just immediately after the global, after the fundraise, capital raised by the banks. But you know, the markets then, a lot of things have changed. 2008 to 2024, 16 years ago, the market structures have changed. In terms of regulation, there is no market that does not go through a cycle. Our market also went through a cycle. And I'm sure the global financial method that we saw in the US, a lot of other rules, other laws and regulations have come up to address the gaps in the market and in terms of market manipulation. So also in our own markets, a lot has happened. And that was what led to the bank moving from being a universal banking license, because banks were using their subsidiaries to do a lot of things. And also people were buying shares because they saw the price going up. How much is First Bank today? It's 20 naira. What if they didn't ask about valuation? Will it go to 30 naira tomorrow or next tomorrow? Yes, they buy. And who is asking? Who are they asking? They are asking other investors who sees the bank moving from 20 naira to 30 naira. A client was asking me yesterday, today, that he has a fund that wants to do a short-term play. And I said, how short is your short term? If your short term is 1 month or 2 months or 2 weeks, forget about it. If it is 6 months, I can deal with that. And I will not even advise you play minimum of a year. We can put a portfolio for you. 6 months, 1 year, I can put a portfolio for you. Equities, we are not gambling. We are buying the underlyings. What are the underlyings we are buying? Company's performance. So from the economics to the business, from the fundamentals of the economy to the business, to the performance of the businesses that are quoted on the exchange. So I will let you know that this company is a dividend, these are the dividend aristocrats. They pay dividend consistently, they have done it in the last 1 decade. And I can tell you that in the next 5 years or 10 years, they will continue. I can predict their dividend history. And I will recommend for them if that suits your investment objective. So largely, people lost money in 2008 because of several factors. One of it is the fact that there was no information. People did not take advice from people that knew. And we do advise. We don't ask you to buy or sell without giving you the reasons why you should buy or you should sell. We'll give you investment advice. We would ask you, what is your investment motive? Your investment motive will be different from his. So I won't recommend what I recommended for you, except you have even if you have the same motives. Your financial situation and conditions are different. So these are the things that we look at to advise our clients. And based on that, we'll let you know this is a good buy, this is a good sell, this is not a good buy, this is where you put your money. I will let you know equity may not be good for you now. Perhaps you go into fixed income and come back to equity later. I'm not going to give you advice based on the fact that I want to make money, because I can make money now. I won't make money subsequently. We want to grow sustainably, and that is what our investment philosophy has affected. Thank you.
Thank you so much for that robust defense of the equity side. Thank you. Chris, we talked about the fiscal side. There is, I don't know if the US Federal Reserve is going to be reducing interest rates and what that does to the environment, but Eurobonds, do you think that we might see the Ivory Coast and who else went to the Eurobond market recently? We think Nigeria would head there?
We saw a return to the Eurobond market from the sub-Saharan African economy in 2020 this year. The Eurobond market has been quiet for SSA for the past 2 years.
So Cote d'Ivoire, Benin, and Kenya went back to the Eurobonds markets this year. And of course, there is conversation that more African countries would also continue to go to the Eurobonds market this year. The three countries that went, they brought back this confidence in emerging markets and sub-Saharan African instruments that you can bring foreign investors to bring their funds, because the three offers were oversubscribed, some of them by more than six times oversubscribed. So, and they were also able to get these investments at favorable rates to them. So even though there is something we call the African premium that is still very existent in that market. So it's definitely bringing more confidence into the SSA region, raising money from the Eurobonds market. And then the federal government of Nigeria has been, they were quiet last year on where they're going to go with Eurobonds this year. But so far this year, they've made some statements. We've seen the Ministry of Finance also comment on the fact that they are likely to come to the Eurobond market in Q4. And trust me, that's something a lot of investors are asking about, and they are definitely willing to see. And then of course, we expect that when Nigeria comes to the Eurobond market, there should be sufficient subscription to the Eurobond market, to Nigeria's Eurobond, because from the international space, even taking an insight from what Said said, there's been more participation of foreign investors in the equities market in Q2 and even in Q3, and that's likely to also impact the Eurobonds market. As to the direction of yields in the Eurobonds market and what investors should do, I think the best advice can only come from the head of treasury and the fixed income market. So I'll allow Okemete to speak on the direction of yields.
Yes, Okemete, thank you.
All right, thank you, Grace. Thank you, Moses. On the direction of yields, I think a lot is hinged on definitely what's happening in the global scene. We've seen them strategically moving towards a lower inflation, and we're expecting like a dovish tilt from that, from most of the global monetary authorities. We've seen the EU already begin to drop rates. We're expecting similar from the US and the UK. When that happens, it will all definitely dovetail into the SSA Eurobond space. So towards second half, last quarter, definitely we should see yields coming down in that space. So what my advice to investors would be, take advantage of the higher yields now if you're interested in the Eurobond market. The Nigerian Eurobond curve is between 9–10% right now. You can still lock in those rates at this time. Towards the end of the year, those yields are going to go down. And I think that is when the Nigerian government would probably like to issue the fresh Eurobonds at that time when yields have come down a little bit. So yes, Nigerian curve, fantastic. We have the Nigerian corporates as well. Very good picks for the investors. If you want to look outside Nigeria, maybe Angola, we could recommend a few bonds on that curve as well for you, but maybe on the short to mid end on that side. But for the Nigerian curve, you can go all the way to the long end. We recommend longer duration, a long duration strategy for you on the Eurobonds, in the Eurobonds market. So I think that summarizes it, but of course we could give more specific information depending on the objective of each specific investor. Okay.
All right, thank you. We are almost at the time, but Prof, let me because I'm going to come back to you with asking for other assets outside of equities and fixed. But Prof, we want to, I guess, give us some final thoughts on your outlook for into the second half of this year.
Yeah, thank you very much. I think everybody's concerned now, and the trend in the first half of the year is not really satisfactory, and government also looking for ways of raising jobs. So I think there is hope in the second half, and we are looking forward to a more stable monetary and fiscal policy, and there will be more injections from the fiscal space, and there could be also be some constraint from monetary authority, but sure, more coordination. So in terms of inflation, I still want to say that CBN need to keep their rates as it is now to build confidence and not to also create more disruption. And two, to ensure that their policies are not counterproductive. And in terms of the forex markets now, it's becoming stable. And people are already getting used to 1,500. And so anything they do, like the other times when they get heavily into the system and rate came down below 1,000, creates false hope that the naira is strong. And between 5 days again, it runs again. That is not, it's not good. So we expect them, even when they have that opportunity, they should give it the reserves and allow the rate, people get used to this rate and be able to plan with this again. And they're trying to start to do. So I think government learn their lesson and we do that and that point. In terms of interest rate, currently now, like you see, the increase in foreign investments in Nigeria is because of the possible returns we have in the sectors. And I believe that will be extended to the equity market also because of these capitalizations and other things that government is doing. But in the real sector, government also have to get in. We are having challenges in our equity market because our market is narrow. We are not creating new equities. We are just redistributing equities, just distribution among existing. So there's no new value created. So government should come in, encourage foreign investors and investors to establish new company, create new green investments, and come in and directly let them be at least be listed. So they should encourage even these small businesses to come together as a group and invest and grow. So because it's easy and more sustainable when those investments are on the stock market because they are all on the public eyes, and that allows them to keep the corporate governance issues will be less, and then again people can also monitor activities. And when you are under pressure, you are being monitored, you are more transparent and accountable to the people and then grow the economy. So government also will need to partner with other private sectors to ensure we create new entities that can invest in our finance systems and also create awareness, public awareness about the positive of the market, not the negatives. To let people know that your money is safe when it's saved with Meristem. Thank you.
Thanks. We're also going to take quick questions from the audience and also online as well. So preparing questions if you have any. Other assets classes outside of fixed income equities, what else is out there?
Okay, thank you. Before, let me just quickly write up the back of the drop for the last comment. I'm talking about investors' education and the depth of the markets. Yes, one of those things we do, and we take investors' education very seriously because we believe, as I told you earlier on, philosophy as a firm is about information. What we sell is information. And we believe that, look, if a population of over 200 million people, and less than 10%, in fact, less than 1% of 200 million is invested in equities. Less than 0.5% is invested in equities. That is, well, we don't see it as half empty, we see it as half full, meaning that there are a lot of opportunities in the market. So we are looking at it from the opportunity perspective that presents opportunity for us to capture people who are not yet in the market. And we do so in so many ways as a plan. We have a lot of programs and information that we push out to capture new investors, to give them information about capital markets, about equities, about fixed income. We also go to the Nigerian universities. We partner with them. We have a program, we call it Meristem Orientation for Rising Entrepreneurs. More than Meristem. We partner with institutions and we let them know, we teach them about markets, about capital markets, and we partner with different institutions that have such faculties that they can also help us catch them young and push investor education. And beyond institutions, even our customers are investors. And we push a lot of content out. We have webinars and the rest to inform the investing populace about how to go about their investment activities. When you want to do whatever investment amount you have saved, you must make invest wisely, such that what happened in 2008 does not repeat itself. That is by the way of investor education. Number two, in terms of the depth of the market, no doubt about it. Government will do, but it's not sufficient enough. Government will bring up policies And we have companies that otherwise wouldn't have been on exchange, if not for government policies. That is from the policy side. From the market side, because market belongs to is an ecosystem. And from the entire ecosystem of the market, government will play its own part. We, the operators and the regulators, they will play their own part as well. Beyond equities, we have other products in the market. We have derivatives in these markets. We have exchange traded on ETFs in the markets. We have mutual funds in the market. Mutual funds and ETFs, they are big time. If you look at advanced markets in Europe and in the US, they are a big chunk of their markets. In our market, it is still at its nascent stage. People need to know more about mutual funds, about ETFs. You don't have to necessarily buy stocks directly if you don't have that knowledge. You have somebody who watches over you, is a fund manager who manages your investments. Just put your money in a mutual fund, and the fund manager is going to take care of every other thing in terms of what you need to do. You don't need to be following the market every day. There is a fund manager dedicated to perform that service for you when you buy into mutual fund, be it equity mutual fund, be it money market mutual fund, be it exchange, fixed income mutual fund, or mixed. There are different bouquet of mutual funds that people can. So that is one of the ways you can diversify as well. If you don't want to have direct exposure to equities, you can also have exposure to mutual funds, and that meets your investment objectives and criteria. Beyond equities and beyond fixed income and mutual fund and all that, people can also diversify into commodities. Commodities are a good edge for inflation and for exchange rate. In the past 5 years, commodities have returned about between 35 to 40% annually. So it would edge inflation, it would edge currency, the devaluation of depreciation as the case may be. So that is also one of the ways. And these days, there are different ways you can also go into commodities, just the same way you can go into equities in different ways. Either you have direct exposure to equities, or you go by the way of ETFs. There are ETCs, exchange traded commodities. In fact, you have commodities that you have commercial papers that focus on commodities. So underlinings of the commercial papers are their commodities, not money markets, not fixed income. So investors can also diversify, from equities or from fixed income by having some level of exposure to commodities as a way of managing their risk profile. I believe it's something that is worth considering. And we have in Meristem, we have a dedicated desk. Just as we have Nigerian Exchange, NGX, and we have NASD, which is OTC, and we have FMDQ, which is fixed income exchange, and other money markets. So also we have commodity exchanges. But a lot of information or education has to go into letting people know that there are other exchanges they can also channel their fund into. And we are doing that on our own part. We have a dedicated commodity desk that we can treat for our clients, either corporates or individual, as the case may be. Thank you.
Fantastic. Thank you so much. A round of applause for the panel. Great information. Do you have any questions in the audience? Just raise your hand. What about also online as well? Are there any questions coming from online? Do let us know. Okay. So please maybe give the microphone your name. Thank you.
My name is Linus. I work in Meristem. So quick one, I want to find out, looking at the government plan, this current administration is to drive the 1 trillion economy. And one of the key things they want to do is to capitalize the bank. And already, I think that started. Now, from initial analysis, from the top 10 banks, about 2.6 trillion is required by them if they're going to meet that capitalization exercise. Then if you factor in the other bank, probably we need to raise about 3 trillion. Do you think that the equities market have that steps to deliver that 3 trillion within the time frame by CBN?
Okay, thank you. I believe that question is directed at me.
Yeah.
Okay, so I believe that what drives investment is returns, right? What is the expected return? So maybe the question we should ask is that, are those offers juicy enough to attract the fund? I can tell you from what we are seeing, we believe that that 4 trillion naira isn't going to be a tough order to cross. We believe that the banks that are coming out to raise funds will be those offers will be successful, because we believe that money will come. People have their money that are flowing into real estate, into fixed income, into other places, even foreign investors or Nigerians in diaspora that want to invest. They are willing to invest, but they want to be sure that there's the security of their fund is quite important. And those offers they are buying, or the companies they want to invest in, they want to be sure that there will be commensurate returns on their investment. And given the performance of the banks in the last 1 decade, most of our top tier banks, top 5 banks, they pay regular dividends. In fact, they pay dividends twice in the year, most of them. So they pay dividend half yearly and they pay full year. And the last 5 years, the level of dividend they have paid consistently. That is a testament to the fact that when you buy into such of course, you need to identify your risk profile. So to answer your question, I believe that given the level of returns we are seeing in the markets and performance of those banks, 4 trillion naira, I don't think is going to be a brilliant task to achieve. I believe the market is that our market is wise in terms of once the returns are attractive and the offers are juicy, then people will buy.
All right, thank you so much for that. Okay, Prof wants to jump in. Prof, please.
Okay, so thank you for that question. So when it speaks from the financial markets, I want us to look at it from the real sector. The 1 trillion economy we're talking about should be in terms of a base asset of the economy, the real sector, because what drives the market is the fundamental values that we have, not what are the base instruments we are investing in. So if you look at our market today, it's seated towards financials in company and co. We do not have much of manufacturing sectors. We do not have more of this. So if government is interested, they should find a way of stimulating the economy from these sectors. How do we create bigger company from agriculture sector mentioned? For everyone concerning industry, even those who are existing are now living. How do we ensure the net flow is higher now? How do we encourage more companies to come to Nigeria? Millionaires are going. So through the things we do. But if we just focus on the quick wins, the low hanging fruit, like I said, low hanging fruit usually they don't get ripe when they are blocked. So the best fruit you get is the one that's hidden under the leaves. So how do we get those ones? How do we ensure that we have more people investing in the real sector? And again, through sector generate the financial investment that people now are having. So we should direct it to. And the financial system again, we need to go more into financial interpretation. Today, people, like I said, many of our banks, they have fixed revenue. And in economics, we only hear about fixed costs. We never heard of fixed revenue. Until now, we begin to see that more than almost around 40% of revenue generated by banks are coming from things that are not really from financial intermediation, not with credit creations, but more or less because of technology they provided, the money they collect on ATM, collect on maybe transactions. That is what is killing the economy, because we now have a lazy banking system where they can sleep and earn income. People are not driving people to come and invest. People are not driving people to come and take loans to credit and not more to the focus of the banking sector, more how they get risk. So until we begin to identify, and I want to sit again to look at the younger generations who had small income, who are also investment conscious. So out of the money they earn from the little content they are creating themselves, that are spending it on the kind of spending that we could create some products that are targeted at the younger generations, that 1 naira, 2 naira, 3 naira invested today become 1 billion naira tomorrow. So can we create products that speak to the smaller savers, not the big investors? That today we grow to become big tomorrow. You come to university, out of the allowance you get for your feeding, you can save 1 out of 100 naira. Invest in this so that by the time you are carrying 4 years, you will become this, do the capital for them and see. If you build that together, if you have around, probably now, if let's say we have around 10 million students in Nigerian universities, and each of them just say 1 naira, that's 10 million naira. Now multiply by the multiple they are doing. That built the market. When they leave and begin to work, that's part of things they build upon. So why they are in school, they are investors. When they leave schools, they are greater investors. So we should look at the fundamentals. And that they do the same thing for the small scale business people who have good businesses. You can ask them out of your money, just maybe 1% can go into investment, and then let it, we run it for you. But by the time they grow and they grow their businesses, and that the culture of investment is already built into the system. And your program say you are doing, you are not enjoying that, and therefore you are nowhere. So I want you to come to investment because we are not in the economics department, so therefore you are not enjoying that. So I want you to come, and I can show you the way to get that. So let him complete that into investment product that can speak to the younger. And like I spoke to you privately, I said the local sector, whether we like it or not, we need to have at least 100% increase in their salary. How are we preparing the market to take part of this money? Because even whether they agree on 60,000 naira or 62,000 naira, and the little one they did 25% again, I saw the increment in our salary. And some of us are not prepared for that. We spend the way we were spending before. But if, as the government is pushing money to the economy, if the financial sector is also ready to be able to handle this as well, we will help the government to achieve their goal as well. And then we also stabilize our market. So let's create product before this National Assembly has the bill, before the money gets to my account, let's get a product that will waiting for me on mobile app. Like, oh, you can invest your item into this as well. And that will get the system working and everybody benefits.
To speak to what Paul said, in terms of about 4 trillion naira will be raised from the banking recapitalization, and as they taught us, I think we have leading indicators and we have lagging indicators, right? I think, of course, our economy is a bank-led economy, and you can't take it away from there. I guess, from the perspective of the government, let us jumpstart the target of $1 trillion economy from the banking sector. Let them be the leading indicator by ensuring that the banks have enough financial buffer to be able to support the real sector. And I agree with him totally. The banks, their core responsibility is financial intermediation, lending to support economic growth. So when the banks are fully capitalized, well capitalized rather, they can support the expected jump or the bigger economy that we want to, the $1 trillion economy we want to create. The banks will be able to support the real sector, the manufacturers, and the rest like that. So that is going to be, so there must be a handshake between, and there must be a continuity in terms of policy and programs of the government. As the banks have started capitalization, so also the government must put in place policies to support, to ensure that the real sector, the manufacturers, they are able to tap into the bank, the new capital base of the bank. And of course, there must be enabling environment, which we also spoke to. So everything is interwoven. There must be, banks also want to lend, I believe, but if the real sector is not the risk enough, banks, they also have to protect their shareholders' fund. You don't want them to lend when they know that that money is not coming back. So they will lend when the economy or the sector is properly de-risked to a very large extent. They can lend to you, they can lend to him, and they know that that money will be put into use for the purpose it is meant for, and it will come back and it will generate more economic activity. So that is the way I look at it. So a lot of coordination is needed from the government to ensure that as the banking recapitalization is going on, The rail sector is also given a booster to ensure that the money can be channeled into productive uses to support the growth we all desire for the economy. Thank you.
Thank you so much. We have 2 questions online. I think we're out of time, but we have to take these questions. I think I'll split it, no, 3, sorry. I'll split them between Praise and Okemute. So Praise, I think this is going back to the tax on the banks. Samuel Ukwezumba says, how will the FX impact companies' performance? No, sorry, no, that's the other question. This is isn't the tax a strong disincentive? Praise.
Strong disincentive to banks or to investors?
I think he didn't say, the question didn't say, but that is just so we can take it from either angle.
So if we're looking at it from the angle of the banks, they were not likely to see that kind of FX gain that we saw last year, this year anymore. First of all, because of course on the devaluation part of it, the impact is going to be different. But then also the CBN has kind of capped the wings of banks. They brought out one of the circulars at the beginning of during the course of the first half was for them to make sure that they don't have a net long position in assets. And what this means is that their assets, their foreign assets must be the same as their foreign liabilities. However, they can have more foreign liabilities than foreign assets. So with that dynamics in regulation, I mean, when you have more foreign liabilities than foreign assets, a devaluation would move against you as a bank. So there's no incentive for banks to hold long foreign assets anymore. And so because of that regulation, we are not likely to see that kind of FX gain that we saw last year again this year. So there is already that bit of it that's already disincentive to banks. And for investors, I mean, well, like I said, most investors are going to be playing in the impact of this tax on their effective tax rates, that which we expect to go up. And then because the effective tax rate is going to go up, the profits is expected to decline. Again, banks can sweat their assets more to be able to cover up for the effective tax rates, that the increase in effective tax rate. But either way, there's going to be impact on valuation for these banks, and of course, wait for and this is coming at a very interesting time, because this is when the banks are looking for investors for the recapitalization exercise. But we still think, like Said said, a lot of the recapitalization exercise is expected to be successful for a lot of the banks, even with the traction that we have seen so far with the 3 banks that have come out.
And one more, this one's anonymous. How will the, FX situation impact companies' performance at the end of the year and going into next year?
That's a very interesting question, because a lot of companies did not expect the kind of devaluation that we saw last year. A lot of companies had, recorded significant losses, and that led to erosion of their shareholder value. We had, I think, Nestle, MTN, and I think Cadbury also facing some of these issues. But the dynamic of this is that most of these FX losses last year was not exactly realized. They didn't exactly sell, they didn't exactly realize these losses on their FX liabilities, so they were unrealized losses. But the rule of accounting, says that you have to recognize losses as soon as they are incurred, but you delay recognition of your profit. So that's just the dynamics that happened last year. And then coming into this year, we think that some of these companies have definitely begun to think of strategies to overcome the challenges that they were not expecting. But now, now the expectation is that it can happen. So there were still a lot of strategies. Companies are beginning to revalue their assets upward, also to change that dynamics of the losses. We're also seeing this capital raise also by some of the banks, and of course some of the companies that coming into the market to raise rights issues. Some of them are having considerations with their creditors to turn their debts into equity. So a lot of this is going to definitely impact the 2024 financials when it's released, but we don't think the impact will be as significant as the surprise that we saw in 2023. There's still going to be that dynamics of FX, because also remember that we think that we're going to end the year at 1,500, 1,006, and then last year we ended our 1,2 on the parallel market. So with that dynamics, there's still going to be some element of devaluation this year, but it's not going to be as significant as coming from less than 400 in 2022 to 1,200. So the impact is going to be less in 2024. And then companies are also coming up with strategies to make sure that it doesn't catch them unawares as much as it did in 2023 full year.
All right, and I think Okemisi will get the last word. There's just a follow-up on the bonds. This person, anonymous, wants to know how they can get access to, I think you mentioned Angola or Ivory Coast. So basically getting access to Euro bonds outside Nigeria.
All right, to have access to the market, we offer Euro bonds for 20,000 and above, $20,000. If you have up to $20,000, you can onboard with Meristem as a client, and we can purchase these bonds for you. We would usually give you an indicative level of where the market is trading, and then you can make your decision. Of course, we'll speak to you first to understand your objectives, and based on that, we can make some recommendations for you. But even for those that don't have up to the $20,000, right, you can still have access to that space by investing in our dollar mutual fund. That bond is heavily invested in Euro bonds, and that gives you access to the kind of returns that you get in the bonds market. So those are the options. And for the local bonds market, the same thing. Just the same way we recommend for the foreign market, we also recommend for the local market. We send out our bond, what we call our bond runs every day to all our clients. So if you're interested, just reach out to us on the chats. I'm sure somebody would get across to you, or you can onboard on our app. We have our Wealth Buddy app. You can onboard there, and then from there you can also access any of our products, or you can send us that email at fixedincome@meristem.com, and we'll also be able to fixedincome@meristem.com. meristemng.com, apologies. So that we have several access, and even on our social media handles, you can also reach out to us. You can also buzz me on LinkedIn. I'm Okemisi Sagwa on LinkedIn, so you can also reach out to me, and I'll be very happy to help you. So we have all these options, and even for the local market, we also have a fixed income mutual fund as well that locals who don't have up to the minimum amount required to invest in bonds can also have access to. We have the money market fund. We have several options that our clients can take advantage of in the market. Thank you.
All right, ladies and gentlemen, very robust session. Prof. Mateo, it's a round of applause for them. It's a very, very important. Thank you so much. Really appreciate it. Okay, and I think to bring things to a close, I think to give a warm round of applause to Tope Oludimu, who is the head of investment advisory and operations at Meristem. So take us home.
Thank you everyone for a beautiful session. Thanks to our panelists. First, we are grateful for the nice session. And thank you to our online participants. We have over 140 participants online, fully engaged with an insightful session. We are grateful. Thank you for sparing this time to be with us, and also for the insights in the market. We are grateful. Okay, thank you so much. And thank you for giving us the avenue to learn and to work out of poverty, like Prof said, that we can buy ourselves out of poverty. And next time we're there to take you through that journey. And also, our brand promise to you. You know, our philosophy says that we are happy when the objectives are met, and we are here. We are failed when you are not happy. We are committed to that as a firm, and we keep doing that. So take you further on your wealth journey. Thank you guys, and have a beautiful day.
True, do. What's not? Stability there. Keep your point out pictures. Put it on. I mean, I'm even playing the advert. But you can help the camera. So, handle yes. That's sure. What my skills? Sorry, use my. I'm sorry. Hey. I'm on the island. Oh, I'm on the island now. Who you?
Fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Minister, let's grow wealth for you. The only way to the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Minister, let's grow wealth for you. The only way to the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Minister, let's grow wealth for you. The only way There's not the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you to get to where you are. Why should your wealth end with you? Let your story continue. Let's go for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation at that. After all, worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth for you. The only way is the way to go. Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation and the generation after that. After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue. Let's grow wealth
for you. The only way to they shot the way to go. If I'm